welcome back to Bill's Market Insights. If you've been looking at global stock charts this year, you've likely done a double take at Japan. The Nikkei 225 is up over 30% year to date. To put that in perspective, it's not just holding its own, it's significantly outperforming the high-flying Nasdaq. This isn't just a cyclical recovery, we are witnessing a fundamental shift in how the world prices the Japanese economy. Today, we're breaking down the 4 theses defining this structural revaluation and why the old rules of investing in Japan no longer apply. For decades, there was an iron rule in finance. The Nikkei moved in lockstep with the yen. If the yen weakened, exports became cheaper, profits swelled, and the Nikkei climbed. It was a simple currency trade. In 2026, that rulebook was thrown out the window. Look at the data. The Nikkei has surged roughly 32% year to date, while the dollar-yen exchange rate has swung wildly between 153 and 160. Yet the Nikkei didn't flinch. It continued to climb regardless of currency volatility. The takeaway is clear. Japan is no longer a derivative of the yen. Investors have stopped gambling on FX shifts and started betting on the intrinsic strength of Japanese businesses. It's no longer a trade. It's a growth story. If it's more currency, what is the engine? The answer is the AI gold rush. Japan has become the world's preferred AI beta. Investors are pouring capital into top-tier semiconductor equipment makers, like Tokyo Electron and Vantest. They aren't betting on high-risk, volatile software startups. They're betting on the companies that build the literal machines, the shovels that make the AI revolution possible. Equally endorsing is the new governance premium. For years, Japan was stuck in a deflationary mindset where wage and price stagnation felt permanent. That era is over. We're seeing wage growth hovering around 5%, combined with the Tokyo Stock Exchange's aggressive mandate for companies to clean up balance sheets and prioritize shareholder returns. We are finally seeing a more profitable, more efficient Japanese corporate sector. Finally, let's look at the crisis in the Strait of Hormuz. Historically, any threat to global energy shipping would have been a death knell for the Nikkei. Japan imports roughly 85% of its energy. A blockade should have sent the market into a tailspin. But this time, the market didn't collapse. It hit new highs. This resilience is the ultimate proof that investors now view Japan as a safe harbor. As global capital looks to avoid regulatory and geopolitical uncertainty elsewhere in Asia, they are treating Japan as a stable, high-tech alternative with a solid rule of law. That influx of global institutional money is exactly what kept the market buoyant, even while energy supplies were under pressure. So, where does this leave us? We are seeing a global repricing of the Japanese market. The growth is real, and the industrial demand driven by AI, combined with domestic reflation, has laid a solid foundation for the long term. A quick word of caution, while the structural case is strong, remember that this bull market is heavily dependent on continued AI capital expenditure. If global appetite for AI hardware cools, the Nikkei will feel it. Keep an eye also on the Bank of Japan's policy, then any developments in the Middle East. But definitely keep Japan on your radar. The lost decades narrative, it's officially behind us. Thanks for listening to this week's macro briefing. If you found this breakdown helpful, subscribe and drop your thoughts in the comments below. We'll see you next time. This content is for informational purposes only and does not constitute financial or investment advice. Market investments carry inherent risks. Please consult with a qualified financial advisor before making any investment decisions.